Well, this is Pouring Over Lemonade with Brian and Neil, episode 3. Today, we're primarily going to go over the Q2 2025 earnings report, which just released yesterday. So, Neil, if you want to lead off, what was your initial reaction to earnings?
So I need to go back and listen to the call a second time. But I guess what I want to share is like probably just more like the sentiment I came away from the call. I think one of the key things from the call is that what a lot of it wasn't really expected because we were getting a lot of the information on like Twitter and X. And I think that they did a fantastic job as far as taking all of these like just this huge volume of updates that they needed to give and distilling it into the most important stuff. So they gave us all the updates on obviously like the key metrics, which were all moving very much in the right direction. They gave us a big update on auto, which was, I think, very reassuring for many others to hear. And they gave, updates on the capital positions, the reinsurance updates. They provided this whole brand new sort of supplement for investors. Um, and so yeah, I sort of came away from that call with like, wow, that was a really strong call. It was a really strong update. It just seemed like everything that they were, when the Q&A happened, it seemed like every question that they were asked, they had like a really good answer for, and they came like over the top with also just a solid business update as far as where things are and where they see them going. So it was almost like as we were going through the call, it was just sort of like them ticking all the different boxes. And I sort of walked away from like, wow, they pretty much nailed everything on the head that they needed to as far as investor messaging and getting the message out as far as where the company is, where they stand, what's likely to come in the future, and what are the things that we should really all be focused on in the future as sort of time passes. So I thought it was a really great update. I thought the team did a phenomenal job. I thought one thing that was really interesting, the first time I think we've ever heard Nick Stead, I think he's like the finance subordinate to Tim on the call. So that was quite interesting to hear him do a little bit of Q&A
Yeah,
there.
that's
Yeah.
VP
And
of Finance.
SVP of Finance, yeah. So that it was great to hear from him. I really found his update at the Investor Day 2, really well put together. I thought he delivered it very well. It was, very strong update. And then I think so. I mean, it was interesting, right? Because I think when I heard him on the call, one of the things that came to mind was, oh, well, Nick's on the call. Does that mean maybe Tim might be stepping away at some point in the future? I mean, that's typically what happens when you start to see.
See,
I wouldn't say typically, but
my
it's sometimes what happens when you start to see other execs on the call. Oh, sorry, do you want to jump in?
my Yeah, I mean, my take here is I see Daniel and Shai getting more comfortable with delegating some of the high-level items. We saw at the last Investor Day, we saw Adina, who spoke that we hadn't really heard from before. We saw Nick also spoke about synthetic agents at the last Investor Day. And on the last Q1 call, Shai was on vacation, and we had Mikal who spoke
Right.
for Shy. So I don't see it as an individual per se or like one position. I see it as a overall effort by Lemonade to get more voices out there to level up, I guess, more of
Oh yeah.
their directors and senior level people. So that's my view. Oh, and I forgot to mention at the beginning of this space, nothing in this call is financial advice. So, we're
Oh
all
yeah.
discussing and sharing our opinions, but please don't make any due diligence as well. So, okay. Was there any particular spot, Neil? Oh, and one more thing I want to talk. Yeah, this was a very big quarterly kind of report. Like there was a lot of information packed in to that shareholder letter. Typically, we'll see maybe one focus and a little bit of generalization of efforts and trends that they want to highlight. But this quarterly report, there was a lot that they covered. So it's a lot to unpack, particularly reinsurance and then car. They also touch Europe, all kinds of things. So Neil, was there one particular area that you were most impressed with the report, or one particular area that really stood out to you?
I mean, I'm not. Yeah, I'm not. I feel like we just sort of expected a lot of it, right? Because it's just a continuation of the same, and they're sort of just executing per the plan. But I think if there's one thing that kind of stood out to me, it was probably the total customer count. The fact that they're sort of very close to 2.7 million already. I think that accelerated a little bit faster than I anticipated. I thought they'd be somewhere in the like 2.5, 2.6 million range. So to see that boost was quite surprising. I was like, okay, that's a pretty big jump. I don't know if that's sort of exceeded your expectations, but it certainly exceeded mine. But I think everything else was largely just kind of in line with what we were expecting. I think there was one other thing I was really surprised about, which was the fact that they were able to lower operating expenditure by 1 million despite all the growth that they've had over the last year. I thought that was really impressive. So that's just another thing that speaks to the operating leverage they're getting. I tweeted about that as well. How about yourself?
Yeah, so the area that most surprised me and I'm most pleased to see, and overall everything before I get into that, everything in the report I thought was, very, very solid and continuation of trends, which we've all noticed and pointed out over the past year and couple of years and further back. So yeah, just I mean, a great solid report, great execution across the board. The area that I was most surprised for was the car growth in combination with the gross loss ratio, because it was at kind of my top end of what I would have expected. So if we look at car IFP breakdown, they went from 134 million last quarter to 150 million last quarter. And last quarter car gross loss ratio was 88%, but now they're down to 82%. So not only did they grow car gross loss ratio significantly, they also have the lowest that they've ever had reported, and I believe that they've ever had overall for car loss ratio. So that's kind of rare to see. Normally, when you grow a new line, you kind of expect to see that number bump up and bump up. And I want to go. I posted out on my X space here. Let me find the chart. The amount of IFP that came from estimated that came from new growth versus the amount that came from rate increases. And I only see about, let's see, it looks like about 10% or so of IFP likely came from rate increases. So if you adjust for rate increases, year over year growth, or sorry, quarter over quarter growth was 18% for car about, and that's an estimate. It's not an exact number. So that's very, very solid sequential growth with decrease. So that tells me whatever they're doing on pricing and converting customers is correct. They did recently say there's no new business penalty that they've noticed for current customers who sign up for car and are cross-sell. Like there's no penalty. So they're able to price customers that they cross-sell from other Lemonade policies um, uh, basically as though they were a car renewal policy. So that's kind of showing you the strength that they have in understanding their current customers and upselling them. And that's combined with the fact that they said about half of their cross sales. This was in the quarterly call. I believe Tim said it. About half of their growth is coming from cross sales as well. So that kind of tells you, okay, half of their car is not being penalized by new business, it appears. So the questions I have moving forward from that is kind of like, how many new states are we going to keep rolling out for Lemonade every quarter? Like, is it going to be consistent that we see one or two new states every quarter for the foreseeable few years? Because that's going to be a lever point for them to be able to continue the cross sales to go on for every state they have renters policies and other policies and they want to cross sell that to car. And according to Tim, they expect to continue that trend. So I assume, and this is a big assumption, kind of, and I assume that they have a steady rollout plan for new states where that's going to be maintained. So that's what I was most excited about.
Yeah, another thing that just sort of moving off topic on auto, but the growth they had in Europe was also something that I noticed. The fact that they were able to grow, I think it was 200%, the IFP growth there. So that was really interesting
Yep.
to see, because that's just another huge lever for them to make sure that they're always kind of maximizing that LTV to CAC efficiency, just having access to those new markets.
Yeah, I will modify that 200% a little bit, that number, because they did have a significant increase in rates. So
My adjusted growth number for them is about 106% or 100% for Europe year over year.
Oh, I see. Okay.
Um, but it's still 100% is still significant growth. And the reason for that is if we look at their gross loss ratio for Europe, it was 91% in Q1. And then in this quarter it was 83%. So uh, they were kind of they were still understanding, I think, the dynamics in Europe to price well. So they had a significant rate increase, about a 49% or so year over year average rate increase for their Europe policies.
Mm.
But it's still 100% growth. I mean, anytime you got triple digit growth, even from the base that Europe was at, that's fairly significant. So yeah.
Yeah, the other thing, I'm just sort of going back to the letter now. The other one, that big area that they gave an update on, was the reinsurance renewal. It was good to hear them reiterate that it doesn't impact their sort of capital planning strategy. So in other words, they don't need to do a capital raise off the back of this change, which was really good to hear.
Yeah. So there was some nuance here that I paid attention to. So first, yeah, Tim reasserted that the 1 to 6 surplus ratio they aim to continue on. And he said it for the next several years. And then I noticed a few times both Daniel and Tim kind of reiterated that regulators are looking for, generally speaking, a 3 to 1 ratio, 2 to 1 ratio, which was not mentioned in the call, but a 2 to 1 ratio is kind of like the bare minimum before an insurer or a regulator for insurance companies kind of starts to get active and really reach out to insurance companies to say, hey, you need to do something about your capital. So I see and in my charts and models, and I think Ironic Ape, if you want to speak to this later, I believe I saw this in your models as well. The RBC capital kind of gets down to, it can get down to about 3 to 1 without a capital raise. So it can kind of get down to, the where you're okay, but you don't really want to go down more. It can go down to 3 to 1 before they really can start to scale, the profitability to a point where the profitability funds growth. So it sounds to me like the next few years they plan to be at 6 to 1, which is kind of what many of us have modeled. But then it gets down potentially to 3 to 1, which is where they're trying to transition and hit at by mentioning that a few times in this call. So that's kind of where I see that going. Uh, I don't see the requirement to do a capital raise based on a potential future where there's a 3 to 1 ratio, but they could certainly at profitability and with strength in the market cap, they could look at an equity raise to grow faster or grow better, showing the market that we're really proving that we're profitable now. We've got gross loss ratios that are extremely solid, and this is our track record. So there's potential for that, but it's not a requirement. That's my view. Anyone have different opinions? Ironic Ape, I know I called you out. I don't want to put you on the spot, but if you want to chip in, happy to listen.
So, well, I'll invite him up as a speaker. I don't think he's come up, but just adding a little bit of commentary there. One of my hopes is that, and I'm pretty sure they're going to follow this approach, which is that they wouldn't do a capital raise unless they felt that the ROI they could get offset the dilution, or more than offset the dilution. That's my hope. And so I think that I mean, I don't want to jump to conclusions here, but I would hope that this is not something that they do until at least they're profitable, because I suspect that's going to just make it a lot easier for the market to digest a capital raise than if they did it while they're still unprofitable. I think even though it's probably wrong, it might give the sort of perspective that they're raising from a position of weakness. And we know that there are many skeptics and bears who are sort of alleging that that's what they're going to have to do anyway. If
Right.
that makes sense.
You always want to do a capital raise from a position of strength. I think we just saw SoFi basically do a capital raise from a position of strength. And the market will react to that, how it reacts to that. My view is Lemonade would only do that, like you said, from a position of strength where they can show a strong ROI. So
Yeah. I'm just going back through the letter. I think I lost my place in it. Forgive me.
So other points while Neil goes through that, cash flow from operations was positive, so that's a good sign. For insurance, cash flow is not the number one thing we look at the end of the day, but it is a leading indicator. So seeing that flip to positive, it was negative last quarter from the LA fires, of course, which was entirely expected from the LA fires. But it's nice to see that flip again. Lemonade also reiterated guidance for adjusted EBITDA break even by the end of 2026. So guidance is intact. I don't believe they said anything about non-adjusted or regular EBITDA guidance, but my assumption would be that that continues to be the guidance for end of 2027. And Tim may have said it as well, but so that's kind of where we are on the bottom line.
I'm just looking at that part in the letter now. They said we have raised fiscal year IFP, GEP, I think it's gross earned premium, and revenue guidance while reiterating fiscal year adjusted EBITDA guidance. So everything up except the actual EBITDA. Is that because they're going to continue to just spend a lot on growth spend?
Yeah, I think the adjusted numbers kind of moderate that. There may be, I have to go through all the adjustments again, which I usually do every quarter, but that's kind of, a week or so later after everything comes out, because that's kind of like on the bottom of the funnel for things to look at. But yeah, I mean, adjusted numbers may consider like stock-based compensation as one item that kind of counts as a loss, but is really dilution and other things like that, which is fair to actually have as a gap loss to consider stock-based compensation, in my opinion. But importantly, does not affect cash flow.
Yeah. I'm just looking through now some of the other numbers that they gave. Premium per customer finally eclipsing above 400. So that was a positive sign. Yeah, gross profit margin, 39% now. It's fantastic progress there, all the way up from 12% in Q2'2025.
We see gross profit increased by 109% year on year to 64.3 million. Gross margin improved by 14 points to 39%, as you mentioned. So yeah, I mean the growth side is great. We see OpEx excluding gross spend to be very, very solid and consistent. So it's the main thing that we've all been calling out is continuing, which is OpEx ex gross spend is basically flat, and IFP continues to go up. Gross earned premiums continue to go up, and gross margins are continuing to go up, which means they're becoming more profitable on a marginal basis, which means the only thing they need is scale, and they are scaling. So marketing efficiency is solid. So everything is on the right track. It's just kind of like a matter of time, in my view.
One of the other things I noticed, just going back to, I think the earlier part in the investor letter, they talked about the IFP year over year growth rate. In Q2'2025, that growth rate's already at 29%. So I'm kind of wondering, are they almost like starting to sandbag the growth rate? Because they're talking about it at about 30%, or I think even Paperbag tweeted following one of Tim's comments of above 30%. So, I mean, if I sort of extrapolate the trends as they are in the shareholder letter, by all accounts, it should eclipse 30% as we get towards the end of this year, like, into 30 somewhere. I'm not really sure if that's their plan, but that's kind of what it looks like if you just kind of play it forward how things are going so far.
Yeah, I might need to pull that comment up from Tim again so I can read it to everyone. But yeah, he basically had a comment saying, "Hey guys, yeah, we might be sandbagging." So
yeah, he made another comment somewhere on the call. I think I can't remember the exact words he used, but something like "we're all engines are ready to go." Was this something along those lines?
I don't recall that.
I'm not sure if the transcript is up yet.
Yeah, I mean, I use the Quartr app, so I download the transcript from there. People can also use fiscal.ai. They have a free, if you want to get the transcript for free to read, fiscal.ai usually has the current quarter for free to view. And if you're okay using your phone, then Quartr app is free for mobile users, and that's a great way to get the call. And if you like using AI and things like that, you can also download it, you know, pop into Gemini or ChatGPT and ask for highlights and everything, which is a great thing to do every quarter.
Yeah. I think Jake streamed the call on YouTube, so maybe able to pull the transcript up from that.
Yeah, I'm looking for Tim's kind of sandbag quote. Do you remember any of the exact phrases or words that he used in that?
I think he might have used the word sandbag.
Really? Okay.
Or no, I think that was sorry, that might have been PB's comment, not Tim's.
No use of the word sandbag. Wait, no, yeah. I was just trying to bring that up for everyone on Quartr. I'll come back to that later and see if I can find it and read it for everyone. All right. Other topics. Any speakers want to speak or have comments? Let us know. There's all kinds of things to discuss and go over here. I guess the TTM gross loss ratio, I was very happy with. If we look at it, it's down to 70%. And remember, it's 70% TTM, which is trailing 12 months. That includes the LA fire quarter of last quarter. So imagine if they didn't have the LA fire. Like when the LA fire drops off, I mean, that number just likely continues to go down. So last year, Q2 2024 was 79% TTM gross loss ratio. And then this quarter it was 70%. So I mean that's huge in my view. So they've gone from quarter to quarter, starting in Q3 2023, they went from 88 to 85 to 83, 79, 77, 73, 73, and now 70%. So you know, it's very consistent. And it's going down, and that's going to drive a lot of the margin improvement that we see year over year. And yeah, I mean, it tells me everything is, you know, basically working. They're able to price risk to rate very well. If we want to break that down by type and go to the supplemental, this is in the shareholder letter. Toward the bottom is the insurance supplemental where they break it down. And we see homeowners went down huge, like homeowners / renters. They call it homeowners multi-peril. It was at 60% for this quarter. It was 82% last quarter. We also saw that they shed. It looked like a significant amount of homeowners between Q1 and the end of Q2. So the average IFP or the amount contributed to IFP, I think was something like 10 million decline in IFP due to rate changes. So we see the homeowners mix moving more toward renters. And I actually saw renters had like something like 28%. I believe it was year over year growth or something like that if you adjust for the change in rates overall. So domestic renters appears to be growing quite healthily. And this quarter's total IFP seems to have been suppressed somewhat. Even though it was a great acceleration IFP, it seems to be suppressed somewhat by the non-renewals of home policies that they no longer wanted to do. Daniel touched on this in the quarterly call. He said that, you know, they're looking to shed policies that they would no longer write under today's standards. So basically what that means is, you know, every quarter, every year, their models for pricing risk to rate get better and better. So that means they have more granularity in which policies are the good policies and which policies are the bad policies. And this is a good thing because that means that every year they can look and see, okay, here are the policies that we think are bad. Let's drop them. And the term Daniel used is basically, you know, they're doing this to make the bottom line better. Like this improves the bottom line. It does somewhat reduce the top line, but improves the bottom line by getting rid of some of the book that they would not write today. So that's good. And that's the homeowner / renters line. Pet is fairly consistent. It's at about 70% gross loss ratio. It's been between 68 and 72% for the last year. Car, as we touched on earlier, 82%, best ever. It was 92% last year. Europe, 83%, starting to look nice. It was at 92% last year. Daniel and Shai said in the call that the Europe product is improving in gross loss ratio. I believe it was something like 20% or something better than their domestic renters was at the same stage of life in the product. So when renters was a few years old or whatever, for domestic US, it was not as good as Europe is now. So Europe is on a great track or trend line. And those are their main gross loss ratios by type that they report. They don't report it for their other line, which is like life insurance and things like that. So,
yeah.
So
Anthony just shared the quote with me from the call. One of the analysts asked a question about the non-renewal program, and Daniel's reply was, maybe just to state the obvious, Katie, but this program also dampens our top line. We are really growing faster than the numbers we reported would indicate. So that's really great commentary to hear.
Yep.
Were you surprised at all by the growth in pet? That was something else that PB noted, Paperbag noted.
I don't think I was surprised because I see trends like in the United States where pet is just becoming a product that people care about and that they used to not care about. So, pet is a product that is well penetrated in Europe. It's got 25 to I think something like 50% penetration for pet owners. People get pet insurance, they know about it. In the US, a lot of people don't really know that pet insurance is a product. It has something like, I believe when Lemonade started doing it 4 years ago, it had something like 2% or something penetration. I believe it's at around 4% in the US, not Lemonade specific, but for the whole industry, about 4% or something penetration. And what we see is there's a trend where more people are having pets. So in the US, less people are having kids. It's a trend where it's going down, down, down. Instead of having kids, they're having cats, and they're having cats, they're having dogs, they're adopting animals too, and they're not treating them as like just a, like a. They're treating them very, very well. Like we see, Chewy, the rise of Chewy and companies like that. People care for pets as though they are their children, and they want insurance for the peace of mind to take care of their cats and dogs. So we're seeing enormous growth in that industry in the US, and it's becoming a product more and more millennials and Gen Z are becoming aware of, and that they want to use. And Lemonade, of course, we have a lot of Gen Z customers and millennial customers who are first-time renters that are under 35. That's Lemonade's bread and butter customer demographic and profile. And that means they can cross-sell a lot of renters into pet. And yeah, so I mean, the growth doesn't surprise me. It's kind of like a trend. There's more people having pets, and that's Lemonade's target demographic. And I posted on X earlier yesterday that there was not a single question from investors or analysts on the call regarding pet policies, which was about 50% of the growth for the IP gain for the quarter. So kind of interesting. And my view is it's kind of a good thing because people just take it for granted. They don't have any questions. It's like this has been the driver of growth for Lemonade, and everyone's just like, okay, like no real concerns there. Everyone's just kind of moving on to car, which is a big area of growth. But I guess when you execute and do well, people don't tend to have questions.
That's a good point. I mean, it goes back to another comment I think I saw you make yesterday, which is around at what point do we think analysts start assigning technology analysts? Sorry, at what point do firms start assigning technology analysts as opposed to old school insurance ones to a company like Lemonade that's sort of pioneering so many of these digital first AI and sort of native tools? Probably going to be some time. It may even take, to the point where, they they start generating profit, and the market cap is a lot higher. It kind of just follows the same thing we've seen with many other disruptive companies before them, right?
Yeah. Yeah. Bradford, I just accepted your speaker request. Do you have any comments you wanted to say?
Yeah, I'm really excited about Loco. Have you all talked much about that?
No,
No,
not yet.
no. Yeah. Yeah. Great point. Yeah. Loco. Yeah. They Shy talked about it a little bit on the call. Let me see if I can bring up his comment so we can go over it. So, right, he says this performance is powered by structural cost advantages driven by our AI platform. One great example of this is a technology we call Loco, our LLM first no-code insurance application builder. With Loco, we can rapidly build new products, launch new regions, iterate on pricing and underwriting, and experiment with various dynamic experiences all in hours instead of weeks, and without touching any code. Loco is a powerful platform that enables us to manage our multi-continent insurance company with unmatched efficiency. And then he talks about competitors here and how, this is going to give them an advantage. Our proprietary technology enables us to expand our geographic footprint with unmatched velocity and limited incremental overhead. He says we are clearly in the early innings of our European journey at Lemonade, but believe Europe is positioned to remain a key engine of rapid profitable growth. And yep, and that's pretty much the commentary that was on Loco. So, Neil, any thoughts on that? Oh, Neil, you're on mute.
Oh, sorry, my mistake. I was just saying I have to wonder how they're going to actually apply this. I think that this is the sort of tool that they are able to use to do a lot of the A/B testing for whenever they develop like a new product and it goes through a different sort of workflow. And I think it gives them sort of the flexibility to do that product design without having to do any semblance of code. And so I don't really know how much faster that will actually allow. I mean, it has to be, obviously there's some effect, but I don't know how much more it's going to give them to deploy these products faster, because I think some of what helps them get these products off the ground is all that sort of like data input that they get from customers also going through the workflow as well. I don't know, does that sort of make sense to you?
Yeah, and on the quarterly call, what I remember listening to as well was so this helps them do things faster, but more importantly to them, it appears that it's about efficiency, so they can take their workers that would be spending more time on doing things like, let's say they're getting ready to launch car in a new state. They said that takes a lot of internal resources, which could potentially be on other projects. So it takes a lot of effort to launch a product in new states, and they want to do that. So this potentially allows them to get that done quicker while still maintaining product velocity on their other products. So it's not potentially going to mean that they, launch car, for instance, in 15 states over the next 12 months. But it does mean that they can launch car and do everything else and launch what other new products, what other new efficiency gains they want to do in other areas as well. So it's kind of also kind of baked into their flat OpEx kind of plan. And this could be already part of their guidance where it's like, all right, we keep OpEx flat and we keep growing IFP. So instead of seeing, everything go crazy with, we're in every state and everything, we may just see that this is supporting the flat OpEx for years to come, while keeping IFP growing, which is, very impressive. And on the current trajectory, they will be the most efficient insurer of the property and casualty insurers.
Yeah, that makes sense.
Bradford, did
I
you
guess,
have any
yeah, I
comments
guess
there?
where I'd like to add some color there is, typically when companies are expanding internationally, especially in the financials, you see them make acquisitions, or you see them like hiring country experts or things like that. And I feel like potentially Loco would allow them to to get around of this need. I also think, while they are going to expand in Europe, why couldn't they also get something started in Asia? Maybe insurance looks very different in Asia, but I gotta think these similar things would apply.
Yeah, that's a great point, Bradford. I think renters is an area I'm particularly interested in seeing them expanding everywhere. I feel like renters is, they're doing it in Europe. It's they're getting the loss ratio down there, and their entire model is allowing them because of their digital first distribution model. They don't have to hire tons and tons of locals like other insurance companies would have to do. They can deploy with a lot less overhead when they enter new countries. Because of AI and the way things are now, it's a lot easier to translate things. Potentially, if they have AI automation for customer service, which is an area they've been focused on, that's a product that they can scale up without a lot of overhead because it's doing everything pretty much in the back end rather than physical offices and things like that. So yeah, the way they've structured Loco and everything appears to be something that lets them expand geographically, and that could mean renters, in Asia, maybe renters comes to Japan, South Korea, some of the higher GDP countries in Asia, Singapore, etc. And that would be exciting to see because their renters product, they're one of the most efficient companies. I can't think of a company more efficient that offers a renter's product based on how they distribute and do all their stuff in the back end. It's just extremely efficient versus legacy companies, which have call centers and people manning them and less automation, which is quite expensive for low value renters policies.
Do you really think they'd go to Asia though, when they have still sort of so much to do as far as expansion in the US and Europe?
Well, I mean, I have to imagine in the higher GDP Asian countries, I mean, that's a significant area of growth. I mean, we saw like Uber went to Asia. A lot of companies are looking at going to Asia, and Asia is actually positioned well for a lot of GDP growth. Obviously, there's tariffs and things going around right now, which can shift things around a bit for the next few years. But there's a lot of growth happening in Asia. There's a lot of GDP growth, so it is a market that companies are highly interested in.
Yeah, I guess I'm just thinking of it from the perspective of things that are sort of mandated. I could be wrong about this, but I believe in the U.S. Renters, people who are renting properties are required by law to have renters insurance. I think that creates a lot of the demand. I think it's similar in Europe, in the markets that they're in so far, where if you're renting a property, you have to get renters insurance. I don't think that same sort of mandate exists in Asia where you need to get, or like I know I've lived in Hong Kong and Singapore before. You never needed to have renters insurance. It was totally sort of opt in if you wanted it. So I'm just not sure that there's like a lot of the same market availability there at present.
Yeah, that's a good point. I mean, it's going to be country by country, just like in the US, it would be state by state, where it's something that has to be looked at, and it may not be viable in some countries. But then, there's opportunities. Some countries may change, and as GDP increases in some countries, things like renters insurance may be something that improves. Personally, like my family, my wife is originally from Vietnam, and we have our insurance is probably the steel bars around every window. It's very hard to break in. So in the U.S., we don't have steel bars. Anyone can kind of break into any house they want, right? If they really wanted to. So things are different, and it's kind of like a country by country basis. But there are expansion opportunities internationally, and there may be countries which could be a good fit. But the U.S., in my view, is still the number one economy in the world, and the one that you really want to operate in and drive a lot of growth in. And then Europe as an entire region is also an area with significant opportunity. Domian, I saw you asked to be a speaker. Did you have any comments?
Hi. Yeah, can you hear me?
Loud
Yep.
and clear.
Okay, great. Yeah, no, I think for me there wasn't really that much surprising things in the letter or in the call, which in itself was surprising to me that the stock went up so much. But it's a good reminder for me that like when you're a part of this community on X and you have been for years, then you know we've done the deep dive on Lemonade. We know a lot of things, but for most people, they're new to the company. They are just learning about the thesis right now. And I think they did a great call, Neil, as you said, or a great job on the call, basically distilling everything down to the most important points so that it's easily digestible for new investors, as well as for the analysts who may have to cover the stock but really don't know that much about the company, as well as the new investor presentation they shared on their investor relations website. I think that's a very good introduction to Lemonade for new investors. And so that's not my forte. Right? I like to dig a little bit into the details and maybe come up with things that aren't so obvious. But there's a great service we can do to new investors, and I think we have several community members who are very vocal. Just well, frankly, stating the obvious, but that's a job that needs to be done, and that's a very good service to new investors, just to get them interested in the company, and then they can start doing the deep dive, and then there's other community members providing more value there. So yeah, for me, it was surprising to see the stock go up this much, even though I was expecting good results. And yeah, I think we'll continue to see more of this going forward. I'm on the record as saying that I'm expecting loss ratios to be in the 60s for the remainder of this year. And then afterwards, they may tick up a bit when car ramps more significantly. Um, so yeah, I was very happy with the results. I admire the company and everyone who works there for the job that they've done. I think they're doing great, but I was expecting them to do great, so I wasn't really surprised by anything in the earnings letter or in the call.
Yeah, great commentary. Sam, I see you've got your hand up. Do you want to speak?
Hi guys, it's been a while since I joined this space. We've done it in 2013 with Neil, you know, back in those good days.
Yeah. Christian.
I remember you and Christian were still doing it. I'm still super thankful for Christian for posting this tweet in, I believe in I think December 2022, when he was saying that you know, when all the metric was going right and Lemonade stock was going down, that's what's called a opportunity, and that's where my rabbit hole started with Lemonade in general. So very thankful to Christian and Neil, you know, for creating those spaces back in the days to help me to understand lemonades. Um, couple comments for me just to, you know, I don't agree with Brian's point of expanding to other countries in general, simply because there's so much for them to do in the U.S. and perhaps Europe, right? I think they need to really focus on what the oceans of opportunity, you know, pet it's a, you know, it's an ocean of opportunity. There's so much growth in pets in United States and in Europe, perhaps, you know. And car, it's another ocean that they need. They have a, what, I don't know what the term is, like what, 200 million a premium, and Progressive has like I don't know, 50 billion or something like that. You know, it's like, it's not even comparable, you know, what they could accomplish if they focus, right? And that's my comment on that. I mean, I think they should focus what they do best, stay in the US, perhaps expand a little bit in Europe, you know, whatever they want to do. But there's so much to do here, there's no need to lose that focus. That's comment number one. Comment number two, I was really surprised by the results of the quarter. I didn't think the report was 30% greater. That I didn't think the the company, what they reported were 30% better than the stock prices. To be honest, we've held the stock for a long time, and we went through the ups and downs. We all started buying at around $10, $16 around that range, right? So I didn't think that the stock went up that much. And then I sort of did a little bit digging last night and take a look at the why. I'm trying to like search for why, right? We're always trying to understand why, right? Why the stock went up 30%. I don't know if you guys discussed it. I joined a little bit late. So my theory was that obviously they accelerated, 29%, which is great, what they promised, right? But one thing that stood out to me, I don't know, somebody posted on X, which caught my attention, was the adjusted EBITDA was 40 billion, 40.7 to be exact. But if you take a one-time item on the adjusted EBITDA of 11 million, 11.8, I think was the number, then the adjusted EBITDA dropped to 29 million, minus 29 million. 1 quarter ago, which is Q1 in 2025, the adjusted EBITDA was at, I think, minus 47. So in 1 quarter, I mean, most of that gain is from the net income. In the net loss dropped from minus 60 million to minus 40 million in 1 quarter, and I think that's a big big thing for Wall Street to wake up in a way. Simply because if they drop 20 million in adjusted EBITDA in 1 quarter, so if they can continue this trend, what that means is they possibly at the end of this year, or maybe even most likely early 2026. I mean, they promised end of 2026 to be adjusted EBITDA positive, break even. So I think they could, if they continue this trend, they could probably do it in early 2026. I think this is the reason why the stock reacted the way it was, because of this. Every time when they reported something and they move ahead of schedule, I'm sure Neil remember this, that when they, I think in the middle of 2023 or something like that, when they move ahead the schedule and they're saying that, hey, we're gonna break even earlier than 1 year earlier than expected. I think the stock jumped like 50% from like $10 to 15 or 18 to $17. I think this is what happened yesterday, that they sort of, I mean, it's sort of buried in the statement, because there's a one-time item that due to some warrants and LA fires and all those things. So that's my take, and you guys can take it away. So that's one I want to share with the group. Yep.
No, that was really great. There's one thing I want to add there. As far as the move yesterday, I think that a lot of that comes down to like the technicals, as far as how much the daily average volumes are traded, and how much new short interest we had coming into the earnings. So I don't know if a lot of people saw this, but Jake posted it, where he noticed that the short interest had ticked up by an additional 1 million shares over the weeks leading right up to the earnings report. So I think the stock was hovering around like $40, and then we saw 1 million new shorted shares come into the flow. And I think that's what ultimately suppressed the price back down to 36. And I posted about this yesterday, and I was kind of like spamming Twitter with it, just to sort of like highlight, hey, are people aware that there were 1 million new shares that came in just in the last few weeks? And this is a stock that's sitting on close to $800 million of short interest. So it was a setup very similar to that. I think it was Q3 2023 earnings report, where the stock did the 47% move. And it had a similar setup, where I think it was because of the sort of situation in Israel around the time as well, the October 7th events. There was even more doubt being cast on the company. At the time, there were a lot of liquidity concerns. Like, a lot of people were talking about how the company was going to be bankrupt. And so they came out with a really strong message, sort of doubling down that, hey, we have absolutely zero liquidity concerns. They brought forward that guidance. And again, with all that sort of fresh short interest, and then like this, like, it was kind of one of those things where nobody was really paying attention. Suddenly the company delivers a really strong update with really solid messaging. I think that's, you look at a lot of the market technicals, and I think that's what contributes to some of these like really outsized moves. So that was I think one of its biggest single day moves, that 47% move. I remember that very, very clearly. And then I think yesterday was maybe its second largest move up. There may have been actually bigger moves up back in like 2020, 2021, but I wasn't like, looking at the stock as intently as obviously I am now. So I don't know if Brad, you got your hand up. Do you want to add something? It might be a glitch. I know this happened before. So
well, let me cut in first here because I just want to get some commentary in here. First, Sam, excellent commentary and points you added. Really appreciate it. I can tell there's great depth there, and you hit a lot of great points. As far as the share price movements goes, I tend not to kind of discuss that too much, just because I mean, in my view, Lemonade is under my fair value estimate. So, anytime the price goes down 30%, up 30%, if it's less than my fair value estimate, in my opinion, it's not where it's not where it deserves to be, in my view. Subtracting, I guess, execution risk, I guess. But even with that, my intrinsic value is well above where it is right now at 50. I think it could double, and then I'm about at where I like personally. But that's not financial advice. And investing is a roller coaster for small cap growth stocks. I mean, we see with Lemonade, it's not been a stock, historically speaking, that appreciates gradually and consistently over time. It's not like a mega cap where you see we see the growth, we see the consistent growth. We're just going to add a little bit every day, a little bit every week, and make sure the earnings is on track. And then we're like, okay, this is fine. Maybe we'll go up a 3 or 5% at earnings. Now, this is a stock that'll go straight. It'll go down 10%. Earnings comes out, it'll go up 50%. It'll go down 20%. So you just have to really be prepared for volatility. And I don't want to focus too much on share price. Obviously we're up big right now, and I think it's great to see that the market is rewarding us and the Lemonade team's efforts so far. But as a shareholder, we always have to be prepared for volatility. There's a lot of short interest. In my opinion, all these shorts will eventually have to buy. So that's, like 30% future buyers coming in the stock. So yeah, but I don't like commenting too much on share price changes, just again, because, it's below my fair value. And as long as it's below my fair value, I think it should go up. As far as your comments on where Lemonade should focus on, yeah, I don't think renters internationally, Asia, wherever, even Europe necessarily is an area, like I need or want them to focus on. Like car is my number one focus, and domestic car for the United States. Like that can drive an enormous amount of value for shareholders and for the company. There's so much opportunity in car. And then pet continues to be important. If you want to do like the BCG matrix, pet is kind of like the cash cow and the star of the company at the same time right now. And car is right now it's like a question mark, but it can transition to a star soon, is what it's looking at for me. And renters is pretty much historically their cash cow and star as well. So yeah, I mean, that's where I want them to focus on. I want them to focus on a car, get car right, keep expanding car, and then keep everything they're doing with pet and renters, because they're doing amazing there. So that's my commentary there. Again, thanks, Sam. Appreciate all the comments. Bradford, go ahead.
Yeah, I'm on my car, so it may look like I'm unmuted, but I'm meeting with my car. So yeah, I agree. They need to stay focused. I'm just saying they can expand wherever they want now because of this Loco, and I think that's really bullish. And they're not limited by language or like regulatory expertise. Like they can use AI for that. They can use their experts for that. I did think it's very bullish that there's no like European regulator that's lording over all these rate changes, that they can freely change rates in Europe and not have to wait for rate approvals. I think that's extremely bullish. You were talking much earlier about states, like how many states are they going to add as a regular cadence? and states where they're in a very favorable regulatory and rate environment. So as long as there's several different states to pick customers from and serve ads to new customers, I'm not going to be grading them by what states they're in and why. I thought the female Wall Street analyst on the call was really good. She asked them essentially, she's looking at loss ratios like you are, Domian, and she's like thinking, okay, well, loss ratios are going to go down in the 60s. How should we think about loss ratios? And Lemonade's response was, well, we want to keep them in the 70s. They're seeing a huge benefit by being able to compete very favorably on price. So I thought that was really exciting. And that was like a reason why, despite me being a stock investor and us having a large position in Lemonade, that's why I signed up for Lemonade car insurance right away, is it was going to be a huge savings for me, provided I can, drive safely and keep my rates low, as they were offering me a huge discount from what USAA was offering.
How big of a discount did you get, Bradford?
About 160 a month. Yeah, which is really substantial.
And was that the pay per mile plan?
No, but I did have to say, okay, the two cars that we drive, how many miles are we driving per year? And this other car that I don't drive as much, which is my Cybertruck, how many miles are we doing there? And then like the biggest cost savings were like a commitment around how safe a driver I am. So like I've been supervising Tesla FSD for a long time, so I'm like going to be driving my car on FSD, but supervising it, making sure it's real safe, and not driving at night, not driving in traffic or avoiding high traffic areas. And I think there was one other, but I'm forgetting what it was.
When you signed up or before you signed up, did you notice any attempt for them to convert you, or were you just like, because you're so active in the space, you just kind of went straight to their website and signed up and they didn't contact you at all?
Yeah, at first they didn't contact me, so I signed up under an email that I wasn't on a wait list for, so I didn't have like an email from them. There was no active active effort on their part, but then subsequently to that, I did receive an email, and I shared this a little over a week ago, where they sent me an email. It had a pretty clever subject line, and this was to my other email address where I was on the wait list, and the subject line was the word car. I think it's like repeated like 9 times without spaces, so it's like very attention grabbing.
Interesting.
And they were reaching out, like trying to get me as an Indiana customer.
Interesting. Yeah. Yeah. Thanks for letting us know. I'm always interested. If anyone has been reached out to by Lemonade for their other policies, I'd be curious to know how they contacted you to convert. I know they also do mailers, which is old school, but they try and do things, to get people's attention. So yeah. Quartr.
Let me
Go ahead, Bradford.
let me continue here. So I think one of the big reasons for share price increasing was like we've all been waiting for car to launch, and the call they held after the end of the year was disappointing. Like they didn't start in the fourth quarter. I was kind of hoping they would. Maybe I was too optimistic. And then the call they had after that, they really didn't seem to start in car. So investors, I believe, were starting to doubt when they were going to start. And our growth rate for this past year, for 2025 calendar year, was a lot higher than how they started out. So to see it be verified and for us to have evidence of it, for us to see the loss ratio in a reasonable level for car, I think is extremely bullish, and I think it removed a lot of doubt from the stock and from their story. So I think it's a fundamental change, and I agree with you, Brian. Like our valuation, if they have a strong growth year this year, our valuation is like around 133 a share. That's not a price target; that's a present valuation. So we still think it's undervalued. And if they were to raise capital later, we'd hope they would do it at 133 a share and not like at 80 a share or something like that.
Yep, makes sense. All right, we've got some. Thank you, Bradford. We've got some more hands up, so I want to be able to give people a chance to speak. First, Kartiv, and then after Kartik, if Domain wants to speak as well. Kartik, go ahead.
Hi everyone, wonderful community. So one thing I wanted to check, like I have seen in by studying other medical insurance companies that okay they have some government restriction where like 80% of the premiums must have to pay it back to customer. Does Lemonade have those kind of restriction? Maybe some states, maybe we know because insurance is like a state by state legislation. And yeah, another thing I wanted to know if anyone have like a daily short area, like a daily data on like a percentage of short. I mean, yeah, I am curious. Like, is it last 2 days? Was it more short covering or it was more of a like a general buying? Yeah.
Yeah, thank you, Kartik. Yeah, so the ACA, for people invested in Austria, this is something they're really well aware of. There's a 80-20 rule, which basically says that 80% of their premiums has to go toward the medical cost, and that kind of is a way of saying, hey, you're not making profits by reducing the amount of medical coverage have. You're making profits by your efficiency with that 20% that doesn't go toward paying medical bills. So in insurance, I can't say definitively because I haven't looked at every single state's laws and regulations. Basically, in the US, every state has its own insurance regulations, and it can be different for every policy type. However, generally speaking, I'm not aware of like an 80-20 rule. What happens is you have rate increase requests because of inflation. So, every year the government prints more money, and because of that, there's always going to be some inflation. The Fed said their rate is 2%. Obviously, some things have more inflation than others. Like there could be more inflation in car repairs because car bills get more expensive, the technology gets more expensive, et cetera, et cetera. So what happens is as things get more expensive, Lemonade and insurance companies will request rate increases state by state with their regulators to say, hey, if we want to maintain our profitability, we need to be rate adequate, or we're going to leave the state and we're not going to sell insurance in your state. And then the regulators will either say, okay, your request is reasonable and we're going to approve it, or they deny it. And we have seen some states deny it, particularly California. And that's why a lot of insurers have left California or don't write new policies in California. And this is part of the rollout strategy for companies like Lemonade is they will choose to roll out in states. And they mentioned this in the quarterly call that have favorable regulatory environments and regulators. So if there was a state that had a 80-20 rule, it's unlikely that Lemonade would prioritize that state for the rollout. This kind of creates two dynamics. One is that there is some more paperwork and things going on behind the scenes for Lemonade because it's more complicated for them and other insurers to operate in 50 states versus being able to just like in Europe where they're easier to just increase rates as they feel like it. In the U.S., they can't just increase rates; it has to be approved. So that creates more paperwork and more overhead devoted to this kind of work, which is kind of why they part of why they have Loco to help them out there. The other thing is actually create some robustness in the business, in that it's less regulated by the federal government. So if there's a particular state regulator that is not being friendly to an insurer company, they have the ability to, generally speaking, they have the ability to pull out of that state and not continue to do insurance there. So that means they can pull out of a state and they can focus on another state, and that's kind of a little bit of an anti-fragile robustness ability for them, versus, say, a company like Oscar, which is entirely dependent on the federal government ACA. It's not spread out between 50 states as much. It's like, what does the federal government law do in the ACA? Because if that one government decides to change things, it dramatically affects a company like Oscar Health. Whereas in Lemonade, one state does something, well, they can focus on another state. But yeah, that's a great question. What was the second part of the question, Neil? You want to tackle that?
I don't recall the second part of the question. What was it?
Yeah, so it was about, I mean, if anyone has access to daily short data. I mean, I'm more curious. In the last 2 days, is it more short covering or it's like new buying? I'm just curious if anyone has the data about like a daily short percentage. Yeah.
I think there are some providers that give visibility to that. S3 Partners, I know Brad is one of the ones that Bradford uses. I don't actually subscribe to any of those sort of services, so I don't keep that close an eye on it. I mean, I sort of.
I can take over here. Yeah.
Sorry, go ahead.
So I use Fintel, and they don't have all short information. According to them, it's about 30% short interest. And yesterday we did see shorts increase their position based on their information. The amount of short shares available decreased dramatically, which means we would assume that the likely reason is because they were used. So someone decided to get those short share, decide to get those available short shares. So it looks like there was more shorting yesterday or yesterday after hours. They were acquired or something like that, based on Fintel. I don't short stock, so I don't know the exact methodology here for that. But it appears like there was more shorting significantly. Today, the last I checked, it was actually kind of back to normal. I don't know if that means if there was covering today or not, but that could be potentially what happened today. People digested it, people covered. If anyone else has more insights, feel free to jump in. Domian, you've had your hand raised for a while, and then I'll call on Prin and Matt. Go ahead, Domian.
Yeah, I just wanted to react to what Bradford said about the loss ratios. So when Daniel says that the loss ratio, their target remains around 70% or low 70s, maybe, I think basically what he's saying is that he's expecting the loss ratio to tick back up because car is ramping. And since car is growing faster than the rest of the book, or at least the total of the book, and the loss ratio of car is in the 80s, we should expect the loss ratio to go back up. So that's probably why he's saying, like, no, our target is like around 70% loss ratio, maybe a little bit more, because he too expects it to go up. The reasoning he gives for this, like, oh yeah, we don't want to overcharge customers, and when we can lower prices, we should, so we get more market share. I think that's great, and especially from a social good perspective, it's of course very nice not to overcharge your customers. But from a business perspective, if you are already the lowest cost provider, if your price is already the lowest out there in the market, then there's not much use in lowering it even further. And we see that in the renters product. The loss ratio for the renters product has been in the 40s for years now. And that's not obvious because they don't disclose that separately. They lump it together with the home policies, which have a very high loss ratio. So on average, it doesn't look that low. But if you split them apart, and I've actually done this for the past few years, you can look at my timeline on X and you will see the graphs I posted about this. Then you will see that the renter's loss ratio has been in the 40s for quite some time. So that shows that they're not really stuck on that 70%, right? They could lower the renters' premiums and achieve a loss ratio of 70%, but they're not doing that. They're keeping it lower in the 40s because they can, right? I assume they already have a very low cost product for the customer. They maybe have the cheapest one available. So there's not much use in lowering it further, and they can use it to subsidize the rest of the book, which still has some high loss ratios, especially home, and now car as well. Although it's coming down, it's still in the 80s. So yeah, maybe Bradford has some further thoughts on that, but I just wanted to clarify that they're not really stuck on that 70% loss ratio for each separate product line. Maybe in general, but not for each line separately.
Yeah, thank you, Domian. All right, I know we've had a lot of hands up for a while, so I just want to get everyone to be able to say what they'd like, and then we'll kind of open up more commentary. Prin, go ahead.
Hey, can you hear me?
Yep.
Yeah, so I have a comment about the adjusted EBITDA, and I think like I'm not completely certain about it, but reasonably certain. I think we shouldn't remove the other adjustment, the like the employee credits or whatever it is. Like my theory is, if I understand it correctly, that the tax refund improved net loss, and adjusted EBITDA is derived from net loss. So they just took it out so that the adjusted EBITDA is comparable. And I think like if the adjusted EBITDA would be so much improved by that, they would mention it in the paragraph in the letter about adjusted EBITDA, but there is no mention of that. So I think we shouldn't remove it. And also it's the reason why the net loss is so close to adjusted EBITDA, and usually in previous quarters there was a bigger difference. So like if anyone, yeah, like I think we shouldn't remove this adjustment.
Okay, thank you, Prin. Appreciate that additional commentary. Matt, you had your hand up as well for a while. Go ahead.
Hey guys, I was just wondering if anyone knows if they provide any sort of roadmap for states that they're gonna expand with car, like if they provide any updates on progress in other states or when other states are gonna be offered, if anyone knows that. Thanks.
You mean as far as them rolling out auto?
Yeah.
Yeah, so I think that the general commentary they've given is that they're going to prioritize it on a. I'm not sure exactly the different measures they're using to figure out how to prioritize it, but I assume it has to do with where they can get rate adequacy rather, and then rate accuracy as well, because they need to sort of like. I think the way this works is they sort of initially go to the regulators and they say these are the rates we want to apply, and then as the customers that they get in each of these regions start to use the product more and more, they get more and more refinement, and then they go back to that same regulator and try to get more and more refined pricing data. So I think that they're going to kind of slow roll this to an extent. And I don't think we're going to see like a huge, go live of new states this year, because they've still got these markets to focus on, Colorado, Indiana most recently. And I think that they're going to keep focusing on those before they really start to roll it out in a much more accelerated manner. I don't know, Brian, if you have any other thoughts on that.
Yeah, I'll read from Quartr what the commentary is from Nick Steed, the SVP of Finance. So thank you for your question, Matt. That's a great question. So if we go to Nicholas Steed's commentary, he says, let me find it again. We are currently live with our car product in 10 states, which address roughly 50% of the U.S. car insurance market. That has been increasing with 2 state launches, Colorado and Indiana, in the past few months. We have plans to continue to increase our nationwide coverage and expect to launch multiple additional states through the end of 2026. such that our 50% coverage metric is notably increased. As we look to the state launch roadmap, several factors guide us. We evaluate the market opportunity, existing Lemonade customer penetration, and the regulatory landscape. As new state launches typically involve higher loss ratios, as getting a new state online requires rate adjustments post-launch and naturally brings a new business impact. So we manage that strategically as well. I should note that at most other insurance companies, it takes considerable internal resources to launch a new state. But with Loco, as Shai covered earlier in his remarks, we have substantially reduced this amount of work required by our insurance and product teams to do so. So that's their commentary on car guidance for how states that they want to launch. So again, they did 2 recently in the past few months, and they continue to increase nationwide. And they said through the end of 2026. They didn't say anything about 2025. So, they may not launch anymore this year. It's kind of like there's some ambiguity there in how many states they're going to launch.
Okay, great. But
yeah.
so they don't share which specific states they're targeting?
No, they don't. It's likely that they have some states and that they're making progress on launching in different states. However, they're considering all those factors, up until, I guess, the moment that they decide to, all right, launch. Another thing to consider is the biggest ad spend quarters are Q2 and Q3. Q4 is very expensive for advertising spend. So I don't think you would want to launch a new product in a new state in Q4, all else being equal. You generally wouldn't want to, if you wanted to have a big push in that quarter. I guess you could do a quiet rollout, but I would assume you want to get lots of signups. You want to get all those conversions. You want to be able to target everyone as much as you can, which means you would probably want to launch them at the very end of Q1, maybe March. And then Q2 is all great quarters. Q3, probably, people are generally doing things in the signing up for things in the summer. So, maybe September is the latest you would really want to launch a new product, but August and even beforehand. So, maybe we don't see any new states the rest of this year, but then start seeing them again pick up in late Q1 next year. That would be my general guess, just based on you're trying to build momentum for sales and get the best bang for you.
Is that your dog, Brian?
Yeah, she's in my room barking. Sorry about that.
That's okay. Does that help answer your question, Matt?
Yeah, appreciate it. I was just wondering when it's coming to Florida, because I want to sign up for some car insurance, because I barely drive. I work remote, so can't wait to get Lemonade down here in Florida.
Yeah, Florida is a bit of a beast, so it's always insurance companies always consider Florida a bit differently than other states.
Yeah.
Bradford, did you? It sounded like you had some commentary when Domian finished talking. Did you have any commentary you wanted to add?
I think he just dropped.
Okay. Yeah, it shows him as a listener right now. I know he was, I think, driving autonomously in his Tesla. Any other questions or comments from anyone? If you want to raise your hand. Oh, I see you requested.
Yeah, there's a couple of speakers that just came up.
Yeah,
One of them was
here we go.
Postman.
Bradford. Yeah, Bradford went through. Go ahead, Bradford. He dropped again, maybe. Okay, all right, go ahead, Postman.
Hey guys, so Brian, thanks for reading that quote. That's really the one that stuck out to me on the last question. And kind of I want to say that that's like my general overall impression with the company, and what really impresses me right now is how much they're able to steer towards all of these KPIs. So with their rollout of car, they're specifically looking at, hey, we have this percentage of people we can cross-sell to in this state where we don't yet have the car product. Let's go ahead and add that as a target. And so, yeah, just the number of KPIs that they're actively managing and being so disciplined. Like even the another answer that really stuck out to me as like a nuanced take that I hadn't quite heard is how well they addressed the reinsurance change yesterday, where they're like, you know, there's multiple types of reinsurance. Obviously, they have some of these tail end scenario reinsurance policies, such as concentration or catastrophic events. But the main seeding one was more about capital management. And so, yeah, when you look at how many things that they're tuning in the business so appropriately, synthetic agents taking on the potential larger credit line next year towards that, it's just every quarter that comes in where they're hitting it, we get more and more confidence in their ability to manage towards these things. And as an insurance company, actuarial data and modeling is their core competency. So don't kid yourselves thinking they don't have models saying, hey, if we roll out car here, you know, here's how much we'll cross sell, et cetera, et cetera. So yeah, that was the thing I love to see. And I really appreciated you reading that exact quote, Brian, because I thought that nailed that. So thank you.
Yep. Thank you, Mr. Postman. Bradford, I heard you speak a moment ago. If you're able to, I'll give you a little bit here so you're able to set it up so you can talk.
Yeah, sorry about that. So, yeah, Domian had a good point. In renters, I'm guessing Lemonade may already be the lowest cost provider. So they don't need to just lower the price even more just to get to a 75 loss ratio or a 70 loss ratio in that. But one thing they did say in car is that they saw a 60% increase in conversions. And essentially that means like for every dollar that you're spending on advertising, 60% higher was converting because of being at the price that they're able to offer with car, with the discounts that they're offering and all that. So I think like until they dominate a certain area, they're going to be aggressive with pricing. And their answer to the female analyst indicated that for me. There's a lot of room for them to grow in pet. Like, Trupanion is still the leader. There actually are some things that Trupanion is doing that are better than Lemonade. So I just found this out yesterday, but one thing they do is they're linked into the veterinarian, so the veterinarian can bill Trupanion directly. So when someone visits a veterinarian, they don't even have to file a claim. They just have to pay their 10% copay. So there's some things that Trupanion is doing well. So I'm interested to see how that plays out over time.
Yeah, thank you, Bradford. Yeah, so the analyst that you're referring to, her name is Katie, looks like Sachs, Sakyys, and Katie with the C, or K, sorry, Katie Sachs, and she's with Autonomous Research. She also covers Trupanion. So I don't know if you also listen to her Trupanion coverage, but yeah, she does cover both stocks. Yeah, so for Trupanion, they kind of complain about their loss adjustment expense and the expense of going, doing the process of doing the claim handling, and that makes sense because they do work behind the scenes with the veterinarian, whereas Lemonade is more, send us. The relationship is between Lemonade and you as a customer of them, and you send them the information from the veterinarian for the claim and the pet history, and they kind of approve the claim or deny the claim. So it's between you two, and that kind of is more efficient. So that's why, Lemonade has a much better gross loss ratio than Trupanion. Trupanion, I believe, is their medical, they pay this same percent in medical bills as basically Lemonade's entire gross loss ratio. I think it's like something like 70%, like 70% or more of Trupanion, between 70 and 78% of Trupanion's expense is just in medical, paying the veterinarian bills. Whereas Lemonade's 70% gross loss ratio includes all of the amount paid to the customer and their cost of handling the claim itself, of the customer service, of all of that, of reading through, the pet stuff. Now you can argue, what is better for the customer, but what is a more profitable business is Lemonade's model is more profitable. And Lemonade, basically they convert customers for pet by going to renters and saying, hey, do you have a pet? Maybe you should get insurance for your pet with us. And they graduate the customers. Whereas Trupanion strategy, they don't have renters policies. They work a lot with veterinarians to say, hey, we have this coverage. Can you advertise for us so that when someone brings in their new puppy to your local vet, they say, hey, do you want pet insurance? We work with Trupanion. We recommend using them. So there's two different models of kind of primary methods of distribution for how they get their customer.
Yeah, if I can interject here, I think if you're only offering pet insurance, then the most efficient and most pleasant way for the customer is that the insurance product is directly tied in with the vets and you don't have to file a claim yourself. But what Lemonade is doing is they're actually trying to profile the customer. So they're not only a pet customer, but later on they become maybe a car customer. And in order to profile the customer, you want to interact with the customer as much as possible. So in that sense, it's probably better for Lemonade if the customer has to file their pet claim, because who knows what else they might get to know about you by letting you do that. So yeah, I think maybe that might play into it. Although from a customer experience perspective, I guess it's most pleasant if the vet just takes care of everything, right?
Yeah, perhaps less pleasant for your vet though. Yeah, there's a lot of differences in Lemonade versus Trupanion Pet, and Lemonade Pet's now like they're in like Google search in 4 years. Trupanion's been around for like 25 years. In Google search, we see now that there's more interest in Lemonade Pet than Trupanion. So the Lemonade's marketing strategy is clearly catching on a lot better than Trupanion's is. So so they're, and it's more efficient. So for them, so it's doing quite well. It's an all-star product. It's growing. 50% of their premiums year over year is basically coming from pet. So I'm really impressed with their product offering. Bradford, you still
and
have your hand up?
And Brian, you regularly track reviews. Like, are Lemonade's reviews better than Trupanion's, regardless?
A lot of these insurers, they don't really try and encourage positive reviews, so it's kind of hard to get a comparison. I do scrape kind of Reddit and other commentary, and Lemonade tends to have the highest positive sentiment as far as positive sentiment can be achieved in the insurance space. So one of the problems that Trupanion has is their pricing versus Lemonade. So Lemonade has age-based pricing, which is like you have a pet, and as the pet gets older, the insurance cost increases, basically. And when the pet is younger, the insurance cost is less because there's less claims and less problems with younger pets as older pets. What that means is when you have a new customer, they will get a much lower quote for Lemonade, and then over time, the renewal policy will increase as the pet ages, and they're more likely to have, a higher insurance or higher veterinarian bills. Trupanion tries to have a flat rate, which is good for customers in the fact that, you know, their bill is not increasing every year, so they kind of have some consistency here. But it's a very big problem for Trupanion to try and scale their to compete with other insurers. Like when there wasn't a lot of other pet insurers, you know, if they had a flat rate and it stays the same every year, you know, that's great for retention. However, now that their pet is more of a competitive space, when you have Lemonade coming in and saying, "Hey, we're going to offer less for your 1-year-old puppy," because a 1-year-old puppy has less claims than a 10-year-old dog, that means potentially a lot more customers are price sensitive, and they're going to go with Lemonade because they think about what is my cost this year, not what is my cost in year 10 or whatever. For my pet insurance. So that creates a problem for Trupanion. I'm not sure what they're doing to address it. I don't own Trupanion stock, and I don't really follow their movements too much other than to check bases every now and then to compare to Lemonade. But you know, that's part of the reason why I think Lemonade's able to capture so much more growth. Being age-based is much more attractive to gaining new customers and first-time cohorts.
Is there anyone else that wanted to come up and ask a question or just give their general thoughts on earnings or just Lemonade in general? Okay. Brian, we're just coming up just a little bit past 90 minutes. Is there anything you wanted to sort of add in closing? Do you want to wrap up here? How long do you think we should go?
Well, yeah, I'll give since this is kind of like a bigger call here because we do have or a space on X here because you know, we just had earnings. I guess we can talk a few more minutes and then just give everyone a chance to have some last minute questions or thoughts they want to share. Yeah, just to recap, you know, I'm impressed and very satisfied as a shareholder with the quarterly report. It exceeded my expectations. You know, gross loss ratio with car and car growth was what impressed me. Probably the singular thing that impressed me the most. You know, I thought it was a possibility. It was within my range of expectations, but it was, you know, at the high end of, you know, the high end of my expectations. So, you know, I'm quite happy with that. I think that gives us a lot to be excited for car rolling out. You know, over the next 12 months and seeing car continue to grow. And we kind of know the cross sale trajectory, know that cross sales are, there's no new business penalties so far that Lemonade sees. And, you know, that's going to be good for them. So yeah, I'm excited to see car continue to grow. It looks great. I mean, 82% gross loss ratio is excellent for where they are at their stage of their car product and for growing car IFP as much as they did. We're clearly in a transition period where last year they were still figuring out everything with car, and now it seems like they've figured it out and they're really just, you know, ramping it up. And you know, particularly next year, I think it's going to be an extremely big part of their growth story. Whereas this year pet is still the growth story, but yeah, very excited for car. Any summary or thoughts, Neil, on things we've covered so far?
Nothing specific. I think I was just very happy with the general call. I feel like sometimes people underestimate like how much confidence a really well executed earnings call instills into market participants. And I think that the Lemonade team just absolutely crushed it on the call yesterday. They had everyone speaking very positively about progress on the company. I was very happy with the way all the metrics are trending, the way that loss ratios are moving down. And again, I sort of said this at the outset, and I think it bears repeating. Every question that they fielded yesterday got a very, very good response. And it wasn't just, you know, here's a question, here's the update. It's like, okay, here's your question, here's your concern. here's my response, and here's some extra information which should give you some extra reassurance about the answer that I just gave you. And I just felt like that was the sort of general theme across the Q&A and across all the different updates that they were able to give. And I'm just, now I'm like really looking forward to, the next few quarters, and especially just I think this is such a big period for the company, for the stock, for the business, for everything, just because I think we're at this sort of inflection point where, in my mind, this is sort of like Lemonade's "we have arrived" moment, where this reinsurance drop. I mean, I've been posting about this so much since they made the announcement. The fact that they've brought it down from 55% to 20% it's just a huge move, and it just shows a lot of maturation in the business. It shows a lot of the progress that they've made. They talked about yesterday they're going to continue doing some of this portfolio optimization to get rid of some of these less than desirable policies, and they're still growing as rapidly as they are, in spite of that fact. And so I just think that, this is, I often comment about how I love being invested in businesses that are firing on all cylinders. I really just feel like Lemonade is that business right now. They're firing on all cylinders. They're hitting every metric that they need to. They're giving all the key business updates. Leadership is fantastic. Like you said as well, they're promoting a lot of the other executives now. And so, very excited about the future. And yeah, I guess I'm just looking forward to hearing more from the company.
Yeah, 100% agree. Any other comments from anyone? Last chance before we wrap up this call.
I'll just say that Lemonade is hardcore. My wife, she turned off the telematics. So like Apple, when you have like all the permissions turned on, Apple will regularly challenge you and say, hey, do you really want to be always sharing your location? And she opted out, and like immediately we got a Lemonade reach out to us. Like they do not want to lose that data, and they want to have continual telematics on everyone. So like they are hardcore about data, and they're very different from Progressive. For me, this change just overall and getting confidence in car, it makes me confident that eventually they can surpass Progressive as far as the size of the business and the value of the business. So I now believe in a flippening.
A flip? Did you say a flippening?
Yeah, where Lemonade will be worth more than Progressive in the future.
Oh,
a flippening.
Yeah, that's some massive upside, like 50x or more. But yeah, I mean, that's what a lot of us are seeing and believe in for the long term, that they'll be able to potentially achieve. And they're on good track, and they're making progress. Every quarter we see a lot of progress. I mean, their models improve, they get better and better. They drop the policies that they don't like. They don't renew them. Their gross loss ratio continues to improve. I wanted to touch a little bit on the commentary you just added, Bradford, that for your wife, she turned off telematics, and then you were immediately contacted by Lemonade saying, well, you have to have that on for us. This is kind of like a transition moment for the car insurance industry overall, where we have this technology of telematics, and it provides greater data insight and therefore greater risk to rate pricing for insurers, where they can see the risk of their drivers versus the other data that they would have that's not telematic based. I believe this is a big benefit to a company that is still scaling, with that targets generally newer cohorts such as Lemonade. Because if you look at Progressive or State Farm or Allstate, these are very, very massive companies right now. And a lot of these cohorts that they have, they've been on for 5 years, 7 years, 10 years. They've been using policies. Their customers have been on their policies for a while, and they are not used to having the requirement for these things. And generally speaking, if you are used to something and it changes, people do not like change. And if they were to require telematics for 100% of their customers, there would be churn for them. Like they would go to Allstate or State Farm if they were Progressive. Like you can't just require it. So it's like a transition period where you get new cohorts, and this is their first time they've set up insurance before for themselves, and they're like, okay, I got to have my always on. And for the first time buyer of insurance under 35, which is generally Lemonade's demographic, they are more okay with having telematics always on. They're more of the the tech focused kind of generation. They're always on their phone. Gen Z in particular, they use their phone for everything, and that's different than some of the other cohorts that did not have to do those things when they signed up for insurance. And what this means is Lemonade can kind of scale and take those new customers that are okay with that. And their experience is entirely based on, the app, like which they put all their effort and energy for the customer facing side into the app and making it friendly and UI friendly. And we're kind of seeing this not just in Lemonade, but across the board, multiple industries. You've seen Robinhood getting a lot of customers that might have been like Schwab or Fidelity or other places because they are so focused on the new models of distribution. Same with SoFi or Revolut Bank versus old school banking and branches. So, customers are slowly adopting, things that are phone focused rather than old school focused. Any commentary from you, Neil?
No, nothing else really. I was just looking at the stock as we were about to wrap up. See, it's near the high of the day. So
I'll add the pitch just so you guys know how these work. So they said you have 6 days to re-enable, and if you don't re-enable by then, like you lose your discounts. So like you lose those safe driver discounts. So that's a pretty big stick and carrot for us.
How much is the discount that you might forego if you don't turn it back on? Do you know?
It's like $160 a month or something like that. Wow. It's pretty substantial.
That's good. So they don't just terminate you. They're just kind of like, well, like a great carrot and stick. Well, you'll lose this discount and you'll have to pay more. And then you have to consider it gives the customer the choice so they feel in control, which is a good approach.
Yeah. Okay, guys. Well, Brian, is there anything else you want to add? Do you want to wrap up here?
I think we covered everything. There's a lot in this report. We kind of touched over all of the big points today, but there will be other things to cover and probably other points that we haven't considered yet. So there's a lot to go through here, and we just covered some of the major ones today. So yeah, I mean, great call. I appreciate everyone's commentary. We had a lot of people speak up today, and I appreciate everyone's comments. A lot of great feedback. You can see the Lemonade community has a lot of extremely intelligent investors here, and that's great to see. Thanks for everyone for joining the call and the commentary. So yeah, that's it from me. Go ahead, Neil. You can close us out.
All right. No, thanks everybody. I appreciate everyone's attendance and listening in and input and everything. It's been great. See you guys again in 2 weeks. Take care, everybody.
All right. Cheers. Bye.